Why cash flow beats appreciation in today's market. And for years, many real estate investors relied on appreciation alone to build wealth. And property values climbed and interest rates remained low, and rising prices often masked in operational inefficiencies. And today's commercial real estate market is different. Higher interest rates, tighter lending standards, increased operating expenses, and economic uncertainty have shifted the focus back to what has always mattered most, and that's cash flow. And for commercial real estate investors and business owners, predictable income is becoming far more valuable than hoping for a property value increase in the future. So, what is appreciation? And appreciation is the natural increase in a property's value over time through supply and demand or inflation. And investors who depend primarily on appreciation are betting solely on the market conditions and population growth, inflation staying low, and investor demand increasing. They're hoping that all of those will generate enough profit for them to sell at some point. While appreciation can significantly enhance returns, it is often outside of investors' control. And factors affecting appreciation include interest rates and economic growth and employment trends and investor sentiment and capital market conditions and just supply and demand. The challenge is that none of these variables are guaranteed. So what is cash flow? Cash flow is the income that remaining after all expenses and debt payments have been made. And cash flow is generated from your gross rental income, your expense optimization, keeping those low, any additional property level revenue streams. But it all comes down to efficient property management. And positive cash flow puts money back into an investor's pocket every month, regardless of market fluctuations. So simply put, cash flow is your income minus your expenses and then minus your debt service, your loan payments. And properties with strong cash flow create immediate value and financial flexibility. Why cash flow matters more today? Well, first reason is interest rates are higher. During the low rate environment of previous years, investors could afford to speculate. And cheap debt often boosted values even when properties generated minimal cash flow. And today, borrowing costs are substantially higher. And properties that cannot support their debt service through rental income face increased risk. And lenders are placing greater emphasis on debt service coverage ratio or DSCR, but occupancy stability and tenant quality and your overall net operating income or NOI. And cash flow has become the primary factor driving financing decisions. Two is cash flow reduces risk, and investors relying solely on appreciation are exposed to market volatility. And cash flowing properties provide insulation through their monthly income and debt protection and reserve funding and flexibility during economic downturns. Strong income producing assets can weather market corrections far better than speculative investments on tight margins. Three is inflation rewards cash flow owners. And inflation increases your rental rates, but also your property replacement costs and your overall asset value over time. And properties with annual rent increases can often keep pace with inflation while also generating a higher income. And as rents rise, your net operating income increases. And when your net operating income rises, property values frequently follow. And this creates appreciation through operations rather than speculation. That's forced appreciation. Four is cash flow creates more investment opportunities, and income producing properties provide capital that can be reinvested into, say, additional acquisitions, or property improvements, or debt reduction, or future development opportunities. And cash flow, simply put, compounds wealth. appreciation is typically realized only when a property is sold or refinanced. The smart investor mindset. And many new investors ask, so what is this property worth? And experienced investors will ask, what does the property earn? And the most successful commercial real estate investors focus on a few different things, mainly net operating income, but also occupancy trends and your expense ratios and the tenant stability, also the debt coverage and any potential for value add opportunities. And these metrics determine whether a property performs today, not just what it might be worth tomorrow. So let's give you a Houston market example. Throughout Houston, Katy, Fulshire, and West Houston, many investors are shifting towards neighborhood retail centers or medical office buildings or industrial flex properties or small bay industrial assets, but also multi-tenant investment properties. And these asset classes often generate stronger and more predictable cash flow than speculative development opportunities, and also with less risk. And as population growth continues across West Houston and Fulshire, investors who secure strong cash flowing assets today may enjoy both current income and future appreciation. So, final thoughts for the day is that appreciation is a bonus. Cash flow is a strategy. And in today's commercial real estate environment, investors who focus on income producing assets are better positioned to withstand market volatility, qualify for financing, and create long-term wealth for themselves. And the goal isn't simply to own real estate. The goal is to own real estate that pays you consistently while creating future value. And the smartest investors understand that cash flow keeps you in the game long enough to benefit from appreciation later. So one begets the other. And that, my friends, is it for the day. Please visit my website, HoustonRealEstateBrokerage.com. You can schedule a conversation, and I'd love to have a conversation with you. Thanks for watching. Have a good day.